I think most people I deal with have been saying literally for years. That QE, when it's done, is going to have created excesses and distortions that will come back to haunt us. And you do believe that that's why many of these financial assets just aren't as durable as they normally would be. Explain.
Yeah, so that's exactly right. The imperatives and the stakes are really high for the Fed to engineer a soft landing at this point. And the reason is because there's a lot of debt and leverage that's in the system right now. And the way that leverage is often calculated is debt divided by earnings effectively. And essentially, if the Fed hikes too much too fast and creates a hard landing, the earnings won't be there, the leverage ratios will skyrocket, and that will create bigger problems. So the way that we think about this is that there are three paths. If the Fed goes to 3%, which is where I think is probably more appropriate, they engineer a soft landing. If they go between 3 and 3.5, I think it's a bumpy landing. If they go beyond 3.5% in terminal Fed funds rate, then they're going to have a hard landing, in which case, with all the leverage that's been created as corporations have issued debt and bought back stock, that leverage is there, and that creates an even worse problem when there's a bigger and more protracted slowdown.
Well, Jim, if that is the case, and I agree with you that it is, don't we have to spread our conversation to the rate scales and the situations of policy in Europe, Japan, China? Aren't they mitigating factors to some extent about how swiftly the Fed should try to normalize, considering that those economies are large and nowhere near the scale of normalization in the pipeline of the U.S.?